This is Justin Pulitzer. This is my weekend review for Sunday, December 20th, 2015. Getting close to the holidays and the year winding down. We had the Fed. They raised interest rates, as we all know, and that now puts us in the zone of policy error. I have been a big proponent of lower for longer. I do believe that this interest rate hike wasn't as severe as the street may believe it was because, as I've discussed, they're still doing what I affectionately refer to as QE light, meaning they're still doing reinvestment of the runoff, meaning if they have assets and it runs off, they reinvest it. So that is a form of QE. I had speculated that the best thing that the Fed could do before hiking interest rates would be to first stop doing the reinvestment. Anyhow, they are basically going to now try to raise interest rates with one foot on the gas while the other foot is still on the brake. So if they're not going to be selling assets, I'm not really sure how they're going to get their rates to rise. I know banks have been quick to raise their mortgage rates, but they're not raising their payment on deposits. So I guess that's going to be a rate rise immediately. But as far as the Fed goes, I'm going to show you that what they are trying to do isn't really playing out the way I think they thought it would. Anyhow, let's get into it. As usual, I like to start with the 6 market keys. So let's take a quick look at the VIX. You can see, as you might expect, we have elevated volatility. We did close Friday over 20, which means the market is still in a very cautionary place. I will say this: I had a lot of people who are very worried about another one of these type of moves, the crash. This Friday here, just so you know, this was a very bearish day. We had a close over 25.20, which is very key. And then, of course, we all know that Monday, which was down like 1,400 points. And, we've rallied basically since then with a bit of a pullback here. Anyhow, if you take a look, the VIX here did get back up above 25, closed well below there, and now came back down into mid-range on the Fed. It's always good to play volatility crushes. People had asked me what's the best way to play the Fed. I said to play for an IV crush, and that was the correct play. We have rallied a bit since then. However, Friday, even with the cruddy close, which really felt forced, I'll get into that a little bit later. We had a quad. Maybe I'll get into it now. We had a quad witch, quarterly expiration. You basically had a market that had been down pretty severely with a panic dump the prior day, overnight inventory in the pre-market in the after hours from the prior night had all been net short, and then we were down pretty soundly on Friday again on not such bad breath. I mean, I think it was like 2 and 3 to 1 negative, and you can see we did have a lot of pops in IV, but it didn't really wind up closing up near those highs. It got up to as high as 23, I guess filled the gap here, and then backed off. However, still being closed over 20 does mean that the market is I guess in a very cautionary place. Really, to be in crash mode, you need to be above 25. We are not, so we could be down more. I'm going to get into that scenario, but I don't necessarily know if it's going to be a complete washout like we had here. So that's the VIX. The big problem, and one of the biggest risks I've said for a while for the market, is this strong dollar. There is some good and there is some bad news. The good news, let's start with the good news. Of course, we are below. I've drawn this channel, this lateral channel. We spent some time above there. We got back to mid channel. We now have a look above and now fell from a lower high. So if we can stay under this day's range, that is, I guess, encouraging. My biggest fear for the U.S. stock market and the U.S. economy is for this to really reverse, get back up to these old highs, and then punch through and make new highs, which really shouldn't be too hard if the Fed is truly going to be in a hiking cycle. We know Dennis Lockhart came out on Friday, and he was talking. He is the most hawkish, by the way, of the voting FOMC. This guy has been wrong forever. He was in favor of still like hiking into the recession. Never really wanted to cut rates. Was kind of against QE. Anyway, he said that what the Fed's version of gradual is going to look like is basically hiking every quarter. So I guess the worst case scenario for us for next year is 4 rate hikes. I'm not necessarily convinced that we're going to see that, and I'll discuss why in a little bit with regard to the Fed keys. But it is good that we are back below this 25.68. If this dollar, granted this is only one day, if this reverses back up, any time spent over 25.68, I believe, is negative for the market. And when I say the market, I mean the stock market. So TLT, Fed is hiking interest rates, but the TLT is up near the pre-announcement highs and basically closing back slightly into this channel, back above the 2009 crash peak of 123.15. You can see on Friday we closed at 123.23, so it's not necessarily a fully convincing close, but it is a close nonetheless, and that is the crisis highs. Anything above there always puts higher bond prices into play, meaning lower interest rates. So if things are so terrible and the Fed is hiking, why are interest rates falling? The answer to that is, I believe, the realization, number one, of the kind of quasi-hike, which I described, about 1 foot on the gas, 1 foot on the brake, and also the slowing of the U.S. economy and global economies. If the dollar is going to appreciate, countries or foreigners putting their money into the U.S. dollar, which I believe has been used for the last few years as FDIC-insured bank account equivalents, because we all know the bonds here are insured by the federal government and the Treasury, as opposed to what is happening overseas where European banks don't have FDIC insurance. So I think wealthy people in foreign countries have been selling their currencies, buying dollars, and buying U.S. bonds, which has been a bid under the dollar anyway. So if the dollar is appreciating and people are putting money into fixed income assets, that is good. If this appreciates in value plus the dollar, it's almost like a double whammy. So they get it, coming and going as far as appreciation on their investments. Anyhow, like I said, rates are going down. As interest rates go down, stock PE multiples should be going higher. The only scenario that I see that not being the case is if we truly are in which I believe, a deflationary spiral, but heading into recession, which is very possible. We'll discuss that when I discuss the Fed keys in a few minutes. A couple of major causes from concern that I have is these high yield. These are the high yield bond ETF. You can see this is down quite a bit. It's about a 50% retracement from the 2009 lows. I'm kind of looking for maybe a move to the 61.8, which is possible if we lose these lows. However, it may just want to chop around for a little bit. We'll have to see. As long as this is under pressure, the market, I believe, is going to be under pressure because a lot of the kind of hocus pocus that has gone on for asset price appreciation has been companies basically issuing debt to buy back stock or pay dividends, meaning they're paying a low interest rate. So it's kind of been, what's the big deal? But now as their interest rates are going higher, that isn't a feasible strategy anymore. Still more concerning is JNK, very similar. These are the junk bonds. They are coming down. We could have a high yield credit crisis on our hands right as the Fed is raising rates. Not a good scenario. I believe that until this kind of ship gets righted, the markets are going to be nervous. They're going to be, and rightfully so. So that is the story with the bonds. The oil is an absolute mess, making fresh lows even Friday, looking like it wants to go even still lower. We're down at $10 here. This had been 39 back here in July. I mean, this is incredible that this is doing what it's doing. I'm going to show you really the more accurate way to look at this, which is the CL, which is the futures. The breakout of the 2009 consolidation range was 37, and the low was 33.20. So we may see a little bit lower, but I am expecting this area to start catching a little bit of price memory at the very least for a bounce, considering how much we're down. There's a lot of talk about this going into the 20s, that the Saudis can produce somewhere between $10 and $20 to $25, and that we may take it down to that marginal cost. I do believe that there is a play here for market share. They're trying to punish the Iranians as well as U.S. producers, make it so cheap as far as the price, making it so expensive, therefore, for companies to produce that they will go out of business, and then Saudis will pick up market share, and then they can raise the price and play the game all over again. Anyway, that's the oil. The problem with oil is that it's being used as and I believe correctly so, a proxy for global growth. So I believe that we are producing more, we have found more oil. Some of this decline is attributed to that, so it's not completely a full-on collapse of global growth, but I do believe there is a very significant portion which is a contraction, and as long as oil comes down, it's going to be considered that growth globally is slowing, and I do believe that that is correct. One of the ways I've been playing this is with Exxon. I had played some put ratios here. I covered them up. The stock rallied. Now we're maybe coming back down a little now that we lost this. I still like put ratios, maybe with 75 as the lower strike, or if you're going to be a little bit longer dated, maybe 75 is your higher strike, and then you sell 2 times out of the money, still lower. But I do still like Exxon in that regard. I believe that they have a impenetrable balance sheet, and they would be the last of the majors to cut their dividend. You can see I drew in a price regression line here, where we've had trouble the last few times, and even look here, the bounce stopped basically to the tick. Now we're pulling back some. So here we consolidated under it. We got a bit of a look above, found sellers rather quickly, and now kind of bounced and now rolling back. So we are making lower highs, lower lows. That is a little bit disconcerting. I do believe if you can get a retest in these 60s, that would be a screaming buy in Exxon, even to sell puts as a long proxy. Chevron CEO might be stud of the year with his comments of the last thing that they'll do is cut their dividend. That's always very encouraging. So as Chevron comes down into these mid-70s to lower 80s, that's probably where you want to maybe sell some puts. We did get a 61.8 bounce here. It was quite a significant one. I do believe that playing put ratios for this, if you want to get long, is kind of the better way if you must play oil. You may want to sit out. I don't necessarily know if there's going to be much to talk about in the next few days as people are still taking tax losses. I do believe that oil will be a story for 2016. Maybe it's pushed to 2017, but I think it could be 2016, and it might be the second half. I don't know if it's going to be the first. We'll have to see. I do think at some point we retest 100 on Chevron. We got kind of close here, but I do think at some point it will retest that 100 area. All right, so that's oil. China. Gotta have your China, right? Anyone see that little funny bit they did on Trump on YouTube? Gotta have your China. It was hilarious. Anyway, we did get a rally back up, basically to the breakdown point like I had discussed. We came back down, kind of found some support on the channel. However, we failed. We basically bottomed out here, trying to rally again. So my theory, we're also really bombed out here as far as the stochastics go, which is good. This 3-day low is really the must hold. So if you start losing 35.68, I think the market will not be happy. If we can maybe continue to rally to see the backside of that channel, and 37s, 38s, whatever in that area. That would be good if we can do that. I've said for a while, China doesn't even really need to rally. It just can't be in crashola mode. When this starts to happen, things get a little bit funky. That is my theory with China. Some good stuff about China is this BABA is acting pretty bullish, actually. It's just kind of biding its time, eating up a lot of this supply. All these buy the dippers here who are wrong, who are getting their money back, haven't been terribly aggressive sellers, but they have been keeping a cap on the stock, so I think you need to clear 86s. Once you clear 86s, you probably see 98s and maybe 100 at some point. The bad news is that this could also just roll over. You can see stochastics are weaker here than here. So to make new highs with weakening stochastics is always very suspect. It could be a false dawn. I'd kind of wait. I'd feel more comfortable if this kind of just consolidated and the stochastics got a little bit closer to the lower line before I kind of really sunk my teeth in any substantial way. BIDU got a little overdone. I was bullish that we would see the channel top. It filled the gap like also I had been looking for. We had a bit of a false dawn here. I guess some exhaustion here. This was an exhaustion rally, and it has failed. So we're coming into a key point. The uptrend, it also coincides with these lows. So I think we can try a right or right out play. If this snaps, then I think we're going to kind of fill up some of this triangle, maybe back down into some of this, into this reference area. So be on the lookout for a right or right out play, maybe with a 200-day moving average stop, meaning if this is violated, maybe you could buy right there. And then if it snaps, it's right or right out. But I also wouldn't mind put ratios to play for a move lower. IBB, there are so many people who want to jump the gun in this. It's just scary. Stochastics are rolling over a bit. I've said for a while we need to take out these levels, this 341.25 to 342.48. Until then, it's just we're consolidating in a range. A lot of people jump the gun these 2 days. That's why we wait for the confirmation, and now we're kind of just rolling back over. The 20-day moving average, we closed basically right on it. I would say if you want to be long, take a look. The 50 has caught it a few times. It's resisted. Now it's kind of acting as support. I think you could be long against the 50 MA for like a right or right out play if we come down, but that's really to me. To me, I would rather really feel more comfortable over these two highs. That's just me. Gilead, which is the best of the best, is showing a lot of relative weakness. Kind of was consolidating in a triangle. The pennant is sort of starting to break a little. However, for the hopeful, we are getting low on the stochastics. There is room for some still lower, but this could be forming maybe an inverse head and shoulders, this being the head, the left shoulder, the right shoulder. But I would really want to see confirmation of that. I do think that this will at some point make a rally back up to these 109s and retest the down channel. That'll be a good right or right out short, or flip and go long for a move still higher. I will say anecdotally, I've done a little bit of research. I read a really actually disturbing article online this weekend, and I've spoken to a few people I know who would know about this that kind of confirmed it. And a lot of people who are kind of like part of the Grinder crowd have been using some of these drugs that they create, their HIV franchise, as preventative measures to have less than safe sex. Very disturbing, obviously culturally, but obviously very good for Gilead's earnings. So I do believe that this stock is going to eventually work higher. I just don't know that it's going to not go lower first. The ideal scenario that I would see is for this to come into their earnings weak, preferably real weak, and then set up for a long. If we rally ahead of time, that could get a little bit precarious. We're spending a lot of time going sideways, obviously in a high volume node. So I'm kind of waiting for either a kind of proof of life of a break of the downtrend line or a move back down to retest some of these lows into this area, the 93s and or the between the 84, 85s, for me to get really more interested. Anyway, with regard to the Fed, we've talked about the 6 Fed keys. That's the jobs, the non-farm payrolls, of course, GDP, basically the Atlanta Fed estimates, ISM, both service and hospitality. Both service and industrial. My mistake. PMIs, very key. Durable goods, which is important. The Fed has cited that autos and housing have been very strong. The only problem is those are very interest rate sensitive. So if rates do really start rising, we could see some issues with those, and that could tank the durables even further. They've been held up a lot by autos and by aircraft. Of course, the dollar, very important. And then, the seventh unspoken key is the S&P 500. Speaking of the S&P 500, Let's take a look at it via SPY. So I proposed that we were looking at something like this type of a scenario here, and that is really what is starting to play out here. I will say this, the stochastics are rolling over. That is not good. Volume is picking up on the downside. I will concede that this was a quad witch and a big quarterly expiration, and I think that the 200 pin is, I wouldn't say eyebrow raising or coincidence. I think not. But it is what it is. We are below the Fed day range. You can see we rallied, took it all back the next day, and then had a gap and go lower. That is that's not good. That is pretty bearish. A couple of things I want to show that are concerning. One, that we're below the 204, which is really the kind of the upper distribution. We're below the old reference high, the 201.90. That isn't good. And we are basically to the top of the bear flag where we kind of broke out from, which is, I guess, somewhat encouraging. The real must hold, though, in my view, is this 197.86, and I'm willing to give a little bit of room, maybe, to the 61.8. The bad news is the SPY is expected to have about a $4 move, $3.98 next week. I will submit that if it's to the downside as IV rises, it will probably mean lower. So a move from 200, that would normally be, let's say, $4, might be $5, and that would be the gap fill to the 195. If we rally back up, that would really take us back up to the 104s, maybe for the gap fill up here, even to 205, 204, 205. So why is that significant? If we go to the S&P futures on the Fed day, the volume weighted average price, also affectionately known as VWAP, was 2050 quarter, which would basically close up this gap for us. And then we know we have the gap fill down here. So one of those gaps is probably going to fill. Which one fills first is anyone's guess. We are pretty oversold here I told you that we sold off in a straight line here. Overnight inventory was short, and then we closed really weak here. Again, this was like 25 points, I think, below VWAP, and then I think this was like a 12 or 14 point close below the intraday 24-hour VWAP. So we are a little bit oversold. That doesn't mean that, oversold can't get more oversold. The ideal situation for me, and I kind of teased this video that I saw two scenarios happening. One would be the oversold bounce where we do rally here and maybe fill this gap, or we have some kind of minor bounce up to the 201.90, the 202, and then roll over again. Or of course, we could this could really be it, and we go higher. We do have a double low in place here. Those are very powerful. They're also even more exponentially powerful when they are taken out to the downside. So like if we rallied a little bit here and then took these out, I believe it would be kind of lights out to the 195 at the very least. The alternative scenario would be we have kind of I wouldn't say a Black Monday and a terrible Tuesday, but we do have maybe some lower to go. I would think that, believe it or not, given the oversold condition of the market, that sell-off would probably be a buy for a rally. That would be a pretty powerful one, maybe even to fill this gap eventually. So if I had my druthers, I would love to see like an early gap down Monday to like these lows, the 197.86, and then kind of take off from there for a gap fill or a move back higher. I don't know which one of those two are going to happen. Of course, I when I'm recording this, I didn't have the benefit of seeing the Sunday futures. I would think, though, given this, that there's usually a little bit of hangover that goes in the same direction after an expiration, so we might see a little bit lower. But I'm not going to discount the fact that this is oversold. This was way shorted, way in the hole. A lot of this was late in the day. You had like I said, the overnight inventory short. Here, a lot of people puked. So it wouldn't surprise me to see some type of an inventory rebalance bounce early Monday, Tuesday. I would rather, maybe even for the whole week, considering it's a holiday week. I think the market's closed on Thursday, and I believe Friday might be a half day. So I have to check that. If you go to the NYSE website, you can check. But great week to sell premium into because of the the quicker decay. Not a week you really want to buy weekly puts in or weekly calls into. So that's SPY. IWM, not help if I could type. IWM not looking great, below my box here, which you don't want to be below that box. We are well below the 117.37 and obviously well below the 120.58. So and below the 61.8 here. I mean, there's a lot of weakness in these small caps. This looks like it's really close to filling the gap. This 110.63. We know that there's some reference lows and a breakout here around 109.65. So if we do come back down here, wouldn't be surprising to me, where I think a lot of people would think it's just going to kind of collapse. It may, but I do think that there'll probably be some reference buyers around here. You can see there was a lot of reference lows in these areas. So yeah, maybe you press a little bit lower. I mean, maybe we do revisit the 107. I mean, who knows? But I do think that this area will probably find a little bit of some responsive buyers. Qs. I think that this has been kind of the poster child for strength. We're still above the 200 and the 100. We just lost the 50 on Friday. One day doesn't necessarily make a trend, although the 20 you can see here has started to roll over a little bit. We are below this trend from the lows. We're getting close to we're basically at these lows, so it's kind of do or die here for the Qs. But I believe that this could set up. I would like to do like some kind of a put ratio where you play for the 105 as the lower strike. That's the 61.8 from the pullback low range. I think that would work early if you can get some weakness on Monday to play that for this week. Considering it's a shortened week, it's not as much risk. But the Qs, I think, are struggling a bit. And the reason I think it's struggling is because of the big dog, Apple. Lower highs, lower lows, not good. We are currently, we closed at 106. That was below the 107 support here. The next real support is 103.12. That's this gap fill. Also, this reference breakout here. 103 is a very powerful level in Apple. It's also the edge of a volume distribution. So if we had like a gap down there early Monday, I might even be willing to play for a bounce or for a put sale. We did, however, what is disturbing, we did lose trend. I've been looking for 100 again on Apple, or maybe even lower into the 95s. So if you want to play some put ratios, I have on the 105, 100 for DTE, meaning 4 days to expiration. So if Apple keeps coming down here, into the 103s or even to the 100, that would be great for me. It would be even better if it didn't do it all on Monday and kind of got down by like Wednesday was down here. That would be phenomenal. We'll have to see how that plays out. There could also be some kind of a bounce to retest the 109, which was also really the breakdown in the backside of the channel, and then roll over, or maybe it's just a look below and fail and we go back higher. I do believe that this is looking like it does want to test a little bit lower, though, and I would be a buyer for a bounce lower. But this does look like a big rollover pattern, which is quite ominous for the broad market. Apple is a huge market cap weight in many indices, particularly the Nasdaq. Amazon is the stochastics are rolling over. Volume did pick up here, although a lot of that I would say was probably because of the OPEX. I actually had something on here which I would normally not do, although I did it for one DTE. It was the 660, 655, and it expired worthless because we did have a bounce early and then wound up closing a bit weak. I was hoping we were going to pin exactly to 660. Didn't happen exactly the way I wanted it, but hey, it didn't cost me anything, not even the cost of a trade, because I had got it on for a credit. Anything above 660, 64 is still kind of bullish. Anything below there gets a little bit iffy. I do believe that you could do some put ratios for a play for a 50 MA test. It is a little bit discouraging, though, that the 20 caught it here and has been a key support for a while, and now we are below it. A little bit cautionary. The ideal situation for this for me, because I do believe we are having a major Amazon Christmas, is that these poor highs don't get repaired now. We get a larger liquidation break, shake out all of the weak hands who've chased this thing, and then set up for a long for earnings. That is kind of, if I had my druthers, that's what I'd love to see. If we do break this 684.82, we should go probably up to the channel high, maybe to even test well into the 700s, maybe 740. We'll have to see how that plays out. But these are poor highs, and if they do get taken, it's a long on momentum to the upside. But like I said, I would prefer for this to get weak, get the IV up, so to sell some puts, maybe play for some type of a gap fill. That would be phenomenal. Chipotle has been the maybe trying to form an inverse head and shoulders, head, left shoulder, right, maybe forming a right shoulder. Really need 532.03 to hold for that. We did get a retest. I had said that I thought that this was overdone this day, although this break to me was quite obvious. And then we had a retest. You have the move, the counter move, and then the resumption of the prior trend. This is really sold pretty hard. I mean, you were like 250 points or more down. I mean, you were down huge. I mean, look, down from 758 down to 532. I think everyone was just looking for this to completely collapse, chase the short, complete mistake, bounced. Now we're struggling. This stock is still vulnerable in my view until you can get back above this 580 to 581. You really want to see this high, which is 589.15 taken, to prove that this move might be over. Until then, I think we're just in consolidation chop. I had been talking maybe this is going to want to see 470s, but I did say that price happens in stages. People, this was, like I said, really oversold. It did correct a little bit of that situation the last, couple of bounces. Maybe now we finally get the resumption to completion here. I will say this. From what it sounded like from the CEO, I think the worst of this could be famous last words, but it sounds like there was just an ingredient that might have been in the supply chain that wasn't good, and it kind of probably has already worked its way out, and they've made a lot of corrections to their quality inspection. So I think the worst of it might be over in terms of the news for Chipotle. The bad news is they still have the quarter, and I think a lot of people are going to be nervous going into that quarter because of the obviously some of the drawdown in the business. You would have had a lateral range. It broke. You tried to recapture most of it. It didn't recapture. And the best thing, believe it or not, for Chipotle would be to sell off in a straight line down into those earnings and then can set up for some type of a relief bounce. If they rally it ahead of time, I think it's going to get slammed on those earnings. So it's going to be a George Costanza situation where I would think to play the opposite. Facebook is doing that thing, like I talked about, the consolidation here. It had a bit of a false breakdown, a bit of a rally. The danger now to me is, I don't know if it's going to be this severe, but some type of a move down. I think you could still be long versus the 50-day moving average that caught it here. If you lose it again, I don't know how forgiving that's going to be. My biggest beef here was that this didn't have the full pullback. I often equate these to like slingshots. The further back you pull the sling, the further you get the bounce. This was sort of like a half-cock move. You really need to retest those 99s, maybe even 96s in my view. I would love to see 93s, like some type of a move here and then a play. But longer term, I've said for a while I'm bullish on Facebook. We did get the regression line. We got the 1.618 fib extension up to the 109.28, even past it to 110. For me, the big bet is kind of over for now. I would love to see this kind of rollover, get all these weak-handed chaser punks out of the stock, and then set up for a long again. Longer term, this stock, I could even see, I know it sounds crazy. I think it could even potentially double if the market stays okay. Obviously, if the market crashes, that's not going to be the case. But Facebook is, pretty much firing on all cylinders. I am a little bit concerned that Zuck is on like paternity leave, and more concerned about giving his money away to charity. That was sort of the end of it when Gates started getting into his, Bill and Melinda Gates Foundation. Now we have the Priscilla Chan and Mark Zuckerberg Foundation. So that's a little bit disturbing in my view. I really wanted Zuck focusing on monetizing and creating new stuff in Facebook, not spending time at the fam. So let's just hope for some more weakness. I would love for the stock to, for the IV, for example, to rally, to sell some puts on this thing. Haven't been able to do that in like weeks and months because it's so low. Let's get a little fear in there. Twitter, I had talked about this setting up as a potential head and shoulders. They really got to get their act together. This was a double low here, basically, and now we're below there. Might want to retest these 21s. I think a lot of this is tax loss selling. I think it's also the fact that they listen, until they up their monthly average users, this stock is going to be in trouble. It still has a growth multiple. It's still not cheap, and it's a stock that has kind of okay earnings and no growth. You need to see some growth in the stock. It's encouraging that Periscope was the app, the iPhone app of 2015, but they really need to get their act together in terms of their Twitter product and make it a little bit more mainstream and usable. Facebook is just better. I mean, Instagram, Facebook, better than Twitter. Google just in consolidation up here. Strung like bull, a little bit overdone in my view. We were getting close to these channel highs. The stochastics are rolling over a bit, so maybe there's some more pullback, but I like Google. If we could get a gap fill, maybe that coincides with the channel low, I would be a very interested buyer. But as long as you're over 752.05, I guess the play has got to be long. 50 MA here caught it. So also, if you want to be long against the 50 MA, that's fine, but a snap or Ruski of it, to me, gets a little bit more bearish. The Netflix, I had said that these tops were starting to look a lot like these. That turned out to be prescient, although I did take a lot of heat on the stream for that. No one ever likes to be long something, and here it's probably going lower, but it kind of is. The rally, we got the 115, which I thought. We got pretty good bounce, lower high, now coming back down a bit. 50 MA obviously has been very key in the past. I like put ratios for this, for a move to a play for the channel low. Again, ideally, what would happen would be for this to really kind of fall out of bed. I don't know. That's a little bit too steep, I think. But for this to come down ahead of the earnings, and then it could set up again for a long. I love when stocks that are coming from new highs sell off ahead of prints, and then set up for at least some type of a bounce situation. But 115 is really key. The stock really needs to stay above that. If you start losing this 114.66, let's call it, or the 50 MA, then I think it's going to set up for a short. I hate to say it, but that is key. If you lose 115s, you probably get 110s pretty quick. If you lose that, you get the 103.88 pretty quickly. So this is really important. If we could retake the 126.35, 126s, as we know, have been important before, then I think you're going to kind of re-challenge these tops. Usually double tops don't hold in situations like that, and you probably would see higher in Netflix. Tesla is still in just like this big chop consolidation area. This looks a little bit like a bear flag to me, which is a little bit disconcerting, but it's still in the context of this kind of big triangle. I'm waiting for a snap one way or another, a break of the triangle lower or a break above, which would take us back up to this area. 265 we've known has been key here. It was key here. It's been key up here for a while. You really got to comfortably get over that. I do believe that a snap of this downtrend would get a move back up to 265. So obviously the longer it takes to do it, the bigger the kind of move would be. Like I said, I want to see a break one way or another before I start playing that stock, really. Price line, as long as it's above the 1280.97, it's still kind of okay. Wouldn't shock me to see this kind of come back down and retest. You can see it did one of these here. It did kind of one of these here, so maybe it does one of these here again. As long as the channel low holds, you can keep playing it off the channel low and keep doing that until it doesn't work, and then short the bejesus out of it for a move maybe back down to retest into some of these, some of these reference lows. But I wouldn't mind a put ratio playing for, maybe a 200-day. You can see that's held. Here, absolutely, here on a closing basis. So I like a play for a move down to the channel low 200-day moving day average confluence. Maybe I'll put one of those on this week. We could work something like that up. I think I'm going to end it I think I'm going to end it there. Keep this a little bit shorter than usual. Anyway, be sure to follow me on Twitter. My handle is @JustinPulitzer. I have a new Instagram account that I'm posting 15-second videos on, like in the morning on trading days, that give the keys that the market are looking at that particular day. So follow that Instagram account. I'm going to put that link in the description below of this video. It's Justin Pulitzer Trades on Instagram. So be sure to like this video, subscribe to the feed. You'll get notifications when I post new videos. You get to see weekend reviews, get to see Periscope rebroadcasts, and special edition videos. Anyway, let's have a good week, and cheers.